Hello everyone. Welcome to the Chapter 8 Workbook Solutions video. Let's go over receivables, specifically bad debts and promissory notes. For starters, turn to page 4. Starting at the very top of the page, Kids R Us is a toy store that began operations this year. At the end of its first year of operations, Kids R Us had accounts receivable totaling $50,000. The store's manager estimates that $1,500 of those receivables will not be collected. Let's record our year-end adjusting entry for uncollectible accounts. The basic entry consists of a debit to bad debt expense and a credit to allowance for doubtful accounts. What's the amount? We determine it by considering AFDA's T account. That $1,500 is the credit balance AFDA should have. Since this is the first year of operations, nothing has yet to be posted to AFDA, making its beginning balance zero. To get that desired $1,500 credit balance, we need to post a credit of that amount. To build the current assets section of the balance sheet, we'll need our AFDA balance along with our AR balance of $50,000. Remember, since AR has a debit balance and AFDA has a credit balance, we'll take the difference between the two, which will yield our net realizable value of $48,500. In the second year of operations, Kids R Us writes off as uncollectible a $500 receivable owed by Susan Clark. Our write-off entry will be a debit to allowance for doubtful accounts and a credit to accounts receivable for $500. If we were to build the current section of the balance sheet after this entry, we'd still use those two accounts, but with updated balances. AR drops to $49,500, and AFDA decreases to $1,000. Note that the net realizable value doesn't change at all, because both accounts decreased by the same amount. Shortly thereafter, another customer, Jesse Heath, noted that he would not be able to pay his $100 amount owed. Write off that receivable exactly as in the previous example. What if Jesse subsequently pays off that $100 to maintain a good credit standing? First, reinstate the AR by reversing the write-off entry. Then recognize the cash collected on that receivable. On page 5, let's examine how the amounts for the adjusting entries are estimated. Imagine a business sells $750,000 worth of merchandise inventory on credit, and that business estimates that 2% of credit sales will not be collected. The adjusting entry debit and credit accounts are still bad debt expense and allowance for doubtful accounts, respectively. To get the amount, the problem states that 2% of credit sales will most likely not be collected. So multiply those two numbers together. Under the percent of sales method, the end product gives us our desired ending balance in bad debt expense. In other words, Our journal entry needs to yield a $15,000 debit balance in BDE. However, as a temporary account, BDE has a beginning $0 balance. So the product we just calculated is what we put in our journal entry. Our other method for estimating uncollectible accounts is the percentage of receivables method. In the following scenario, a business has $100,000 of accounts receivable on December 31st. Experience suggests that 3% of its receivables are uncollectible. The beginning balance of allowance for doubtful accounts is a credit balance of $750. Our adjusting entry is still the regular debit to bad debt expense and credit to allowance for doubtful accounts. This time, it's 3% of our accounts receivable that is uncollectible. So we multiply those two together. The $3,000 is our desired ending balance in allowance for doubtful accounts. As a permanent account, AFDA has a beginning balance, a $750 credit in this case. We need a journal entry that changes that balance to a $3,000 credit. Consequently, our entry needs a credit to AFDA for $2,250. Scenario 2. This one is almost identical to Scenario 1. We still have $100,000 of accounts receivable, and 3% is still estimated to be uncollectible. However, in this instance, AFDA has a debit balance of $500. To achieve that desired $3,000 credit balance, we need to credit AFDA for $3,500. Page 6 purports to address the aging of receivables method. For all intents and purposes, this method is functionally identical to the percentage of receivables method. Normally, the uncollectible portion of AR is calculated with a table showing AR amounts by length of time past due. We'll look at one such table very shortly. For this example, the amount is simply stated. $2,000 of current accounts receivable will probably not be collected. Also, AFDA has a $200 credit balance. The accounts for our adjusting entry are unchanged. This time, we want AFDA to end up with a $2,000 credit balance. But it currently has a $200 credit balance. To achieve this result, credit AFDA for $1,800. Scenario number 2. We have the same details, but this time AFDA has a $200 debit balance. Consequently, we'll need to credit AFDA for $2,200. As for that aging of account schedule, turn to page 7 to see such a schedule for Raider Company. At the far left column, you see the age intervals for how long past due an AR amount may be. The second column breaks out the total AR balance into those intervals. In other words, $88,000 is the total debit balance of AR. $58,650 of that balance is not yet past its due date. $13,220 is between 1 to 30 days past due. $8,930 is between 31 to 60 days past due, and so on and so forth. Our third column shows the estimated percent uncollectible by the intervals. Remember, the longer an amount is past due, the less likely it will be collected at all. We estimate that of the amounts not yet due, 2% will never be received. Once a balance crosses into the 1 to 30 days past due, the likelihood of delinquency increases to 4%. For the final column, multiply each row's amount by its percent uncollectible. The result is the amount we expect not to collect for each age interval. Sum each of those products, and $6,288 is the total amount of AR that we expect not to collect, also known as the desired ending balance in AFDA. All that said, feel free to pause this video and see if you can record the following entries. For item 1, draw a T account for AFDA. Its beginning balance is a $210 debit, and we want it to have a $6,288 credit. To yield that result, we'll debit bad debt expense and credit AFDA for $6,498. Item number 2. Prepare the entry to write off the following accounts. Our write-off consists of a debit to AFDA and credits to the individual AR accounts. You could book these write-offs in 3 separate entries, but I combine them into one to save space. Credit each customer's AR account for its respective amount, and debit AFDA for the combined total of $2,150. Item number 3. What if J. Kurt pays his $450 amount owed after it is written off? First, reinstate the AR back onto the books. Then recognize the cash received. The workbook also asks under what circumstances would AFDA have a debit balance prior to adjustment. AFDA is credited for estimates of uncollectible accounts and debited for the actual write-offs. To find ourselves with a debit balance, we would have written off more than we estimated during the year. Let's switch gears to address promissory notes. You can find the following problem on page 10, where you are asked to determine the due date, interest revenue, and the maturity value for the following notes. Starting with Note 1's due date. The note was issued on September 28th. September has 30 days, So the life of our note will take 2 days in September. After September comes October, which has 31 days. Combined with our 2 days from September, we're 33 days into the life of our note. Next comes November with 30 days. We're 63 days in. Finally, we have December with 31 days, bringing us to 94 days. Since the life of our note was 90 days, we don't need all of December, just 27 days. Consequently, the maturity date of the note will be December 27th. To calculate the interest revenue, multiply the principal times the interest rate times the time period component. We have a 90-day note divided by 360. Interest earned will be $100. The maturity value is the total cash collected. In this case, the $5,000 principal amount plus the $100 interest revenue earned, or $5,100. Pause the video and see if you can determine those three items for note number 2. This note was issued on April 2nd. April has 30 days, so we'll use 28 days. After April comes May, with 31 days. Now we're 59 days into the life of our note. June has 30 days, so now we're at 89. July has 31 days, bringing us to 120 days. August also has 31 days. Now we're at 151 days. After August, we have September. To get to 180 days, we only need 29 days in September. So the maturity date is September 29th. Our interest will be $25,000 times 11% times 180 over 360, or $1,375. Add to that our principal amount. And our maturity value will be $26,375. Turn to page 11. Let's record the following transactions that relate to promissory notes. If you like, try them on your own before proceeding. On June 1st, we sold a $2,000 big screen TV to a customer who signed a 120-day 12% note. When we record a sale with a note, debit notes receivable and credit sales for $2,000. This entry is just like a normal credit sale, save the debit going to notes receivable instead of accounts receivable. While the following information is not provided, don't forget that the sales of merchandise inventory also necessitates expensing the inventory off the books. On September 29th, we received payment on that note. Obviously, collecting a note receivable will entail a debit to cash, and a credit to notes receivable. We also know that we'll credit notes receivable off the books for the $2,000 that was initially debited onto the books. We're also going to record our interest revenue with a credit. Interest will be $80. The $2,000 face value of the note times 12% times 120 over 360. Total cash collected will be $2,080. On October 1st, we grant a 60-day time extension to S. Brown, who already owes $1,000 on account. Ms. Brown signed a 60-day 15% note for the amount owed. Here we're moving this receivable out of AR and into notes receivable. So credit AR and debit notes receivable for $1,000. On November 30th, we received S. Brown's payment, just like the other collection. Debit cash, credit notes receivable, and credit interest revenue. Remove the $1,000 note with the credit. Record the interest earned of $25. Total cash collected will be $1,025. On December 1st, we grant a 90-day time extension to J. Clark, who already owes $800 on account. Mr. Clark signs a 90-day 15% note for the amount owed. Once again, here we're covering an account receivable with a note receivable. So debit note receivable and credit account receivable for $800. We have a fiscal year end before the maturity date of the note the following year. Consequently, on December 31st, we need to accrue the interest earned on J. Clark's note receivable, debit interest receivable, and credit interest revenue for $10. The amount is calculated as the $800 principal times 15% times 30 over 360. When we accrue interest at year end, our time period component is the number of days since the note's inception to year end. On March 1st, we collect the $800 note plus interest from J. Clark. We know we'll debit cash, but for how much? To determine the amount, list what we know. We know we're going to collect the $800 face amount, our credit to notes receivable. We're also going to collect the interest receivable we accrued on December 31st. Finally, we're going to collect the interest revenue earned from January 1st of this year until March 1st, $20. Here, the time period component of our calculation is the 60 days from the beginning of the year until the current date. Total cash collected will be $830. Turn to page 12 for our last few exercises. On October 1st, Happy's TV and Electronics accepts a $1,500 60-day 10% note from R. Beard as a time extension on an open account. The note is dishonored on its due date. Make the appropriate journal entry for October 1st and November 30th. Our October 1st entry will be the basic balance transfer from accounts receivable to notes receivable. Our entry on November 30th is almost identical to the normal collection entry of a note receivable. We're still going to credit notes receivable off the books. We'll also credit our interest revenue, calculated in the exact same manner. Our debit of $1,525 goes back into accounts receivable. Remember, on the maturity date, we have to book an entry. We're either collecting the cash payment or moving the principal plus interest into AR. What would be the journal entry to collect payment on December 30th if Happy's extends the due date for R. Beard for another 30 days, but charges 12% interest? In this case, we're transferring the amount we put into accounts receivable back into notes receivable. On December 30th, the collection date of this new note, record the cash collection of a note as usual. Note the consequence of R. Beard's dishonoring of his original note is that he ultimately has to pay interest on the original note's interest. That concludes the Chapter 9 workbook problems. I've left a few textbook problems for you to attempt on your own. The solutions are available online. Thank you very much for watching. Please let me know if you have any questions.